Margaret Whitfield was standing at her kitchen counter in Dayton, Ohio, on a gray Tuesday morning in March of 2026, holding a cup of coffee that had already gone lukewarm. The radio was playing low in the background, some classic rock station she'd had on for 30 years. The light coming through the window over her sink was thin and pale, the kind of light that makes everything look a little tired. She had just opened an envelope from the Social Security Administration. Not a check, a notice. And tucked inside that notice, buried in language designed to be skimmed and ignored, was a number that told her something she never expected to hear in her retirement. She was going to owe federal income tax on the very benefit she paid into for 41 years of her working life. She sat down, she read it twice. Then she called her daughter and said the same 6 words that thousands of retirees say every single week. I thought this was tax-free. This is not a hypothetical. This is not a rare edge case buried in some obscure corner of the tax code. This is happening right now, today, to ordinary people who worked their entire lives, who paid Social Security tax out of every single paycheck they ever earned, and who are now finding out that the government can tax that same money a second time on the way back out. It is happening in Ohio. It is happening in Florida. It is happening in California. It is happening to your neighbor. It might already be happening to you. Here is the sentence I want you to sit with. The federal government built a Social Security taxation trap decades ago. They never adjusted it for inflation, and today it is silently pulling millions of retirees who think they are middle class into paying income tax on a benefit they were told would be their safety net. Over the next few minutes, I am going to show you exactly how this trap works, dollar for dollar, and then I am going to show you the specific legal strategies you can use to reduce or eliminate that tax bill. Stay with me, because this is the kind of thing nobody explains to you until the letter is already in your hand. Let's start with the mechanism, because once you see it, you will never look at your Social Security statement the same way again. The IRS uses something called provisional income to decide how much of your Social Security benefit gets taxed. Provisional income is not your Social Security. It is a separate number the IRS builds specifically to test you. Here is the formula, in plain English. Take your adjusted gross income. Add any tax-exempt interest you earned, yes, even municipal bond interest that you thought was untouchable. Then add half of your annual Social Security benefit. Whatever number you land on is your provisional income, and that number decides your fate. If you are single and your provisional income is above $25,000, up to 50% of your Social Security benefit becomes taxable. If you are single and your provisional income crosses $34,000, up to 85% of your benefit becomes taxable. If you are married filing jointly, those thresholds are $32,000 and $44,000. Now here is the part that should make you furious. Those numbers were set in 1983 and 1993. They have never been adjusted for inflation, not once. Every other bracket in the tax code creeps upward every year to keep pace with the cost of living. This one never moves. Which means every single year, as wages rise and cost of living adjustments push Social Security checks higher, more and more retirees who were never supposed to be anywhere near this trap get pulled directly into it. Let's put Margaret's numbers on the table. Margaret draws $24,000 a year in Social Security. She also has a small pension of $18,000 a year, and she pulled $12,000 out of her traditional IRA last year to cover a new roof. Add her pension and her IRA withdrawal together, and you get $30,000 of adjusted gross income. Add half of her Social Security, $12,000, and her provisional income is $42,000. She is single. She blew straight through both thresholds. 85% of her Social Security benefit, $20,400 of it, is now sitting on top of her taxable income, taxed at her marginal rate. That is federal income tax on money that was already taxed once when she earned it in the first place, back when it left her paycheck as a Social Security contribution. That is layer 1. Layer 2 is state exposure, and this varies by where you live, which is exactly why the escape strategies later in this script depend so heavily on geography. Layer 3, and this is the one almost nobody sees coming, is Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is a surcharge. The government tax onto your Medicare Part B and Part 500 premiums if your income crosses certain thresholds, using a 2-year look-back on your tax return. That $12,000 IRA withdrawal that pushed Margaret over her Social Security thresholds could also push her Medicare premiums higher 2 years from now, which means one single decision, pulling money out of a retirement account for a roof repair, quietly triggers a tax hit today and a Medicare penalty down the road. That is the compounding damage. It does not happen once. It follows you. I want you to picture your own return for a second. I want you to think about your pension, your part-time income, whatever you pulled out of a retirement account last year. And I want you to ask yourself honestly whether you have ever actually calculated your own provisional income. Most people have not. Most people find out the hard way, the same way Margaret did, standing at a kitchen counter with an envelope in their hand. Comment below and tell me your own numbers, your Social Security amount, your other income sources, and I will tell you honestly whether you are already in the trap or heading straight for it. I read every single comment. That comment section is the field hospital for this exact problem, and I want you in it. Now let's talk about the villain, because this did not happen by accident. Social Security benefits were completely tax-free from the day the program was created in 1935 all the way until 1983. Then Congress passed the Social Security Amendments of 1983 under a commission chaired by Alan Greenspan, and for the first time introduced taxation on benefits above those $25,000 and $32,000 thresholds. In 1993, Congress went further and added the 85% tier. Both times, lawmakers set fixed dollar thresholds. Both times, they declined to index those thresholds to inflation. This was not an oversight. Indexing costs revenue. Leaving the thresholds frozen guarantees that inflation and rising wages will do the tax increase automatically, year after year, without a single politician ever having to cast a vote to raise taxes on seniors. It is a stealth tax increase, built into the architecture of the law on purpose, and it has quietly generated tens of billions of dollars a year for the federal government directly off the backs of retirees who were told this money was already accounted for. So here is what I need you to do right now, not tomorrow. Think of the person in your life who has done zero planning around this. Maybe it's your neighbor who brags about paying off the house and thinks that means they are financially set. Maybe it's your sibling who keeps saying they'll deal with taxes next year. Maybe it's a widow down the street who has no idea her late husband's pension income is about to push her Social Security into the 85% bracket the moment she files as single instead of married. Send them this video today. For some of these people, the strategies I am about to walk you through could save $4, $5, even $6,000 a year, every single year, for the rest of their retirement. Let's get into the escape, because there is one, and it is completely legal. Strategy 1 is Roth conversion sequencing. Before you ever claim Social Security, or in the early low-income years of retirement before required minimum distributions kick in, you convert portions of your traditional IRA into a Roth IRA, paying tax on the conversion now, while your income is low, so that money grows and can be withdrawn later completely tax-free and completely invisible to the provisional income formula. In Florida, with no state income tax, a retiree converting $40,000 a year in the years before Social Security starts pays only federal tax on the conversion and nothing else. In Ohio, that same conversion adds a moderate state tax layer, but still wins long-term because Ohio exempts Social Security from state tax entirely. In California, the math is tighter because California taxes retirement account withdrawals aggressively, so the conversion amount needs to be calculated more conservatively with a CPA before you file anything. Strategy 2 is qualified charitable distributions, known as QCDs. If you are 70 and a half or older, you can direct up to $105,000 a year in 2026 directly from your IRA to a qualified charity, and that money never touches your adjusted gross income at all. It satisfies your required minimum distribution without ever inflating your provisional income calculation. This is one of the single most underused tools in retirement tax planning, and your IRA custodian can execute it with one form. Strategy 3 is asset location and municipal bond awareness. Remember, tax-exempt interest still counts toward provisional income. Many retirees load up on municipal bonds assuming they are invisible to the IRS, and then get blindsided when that same interest pushes their Social Security into the taxable tier. Working with a fee-only fiduciary to restructure where your interest-bearing assets sit, inside versus outside tax-deferred accounts, can materially lower your provisional income without changing your actual investment risk. Strategy 4 is controlling the timing and size of retirement account withdrawals in the years before and after your Social Security claiming date. Filing a specific withdrawal plan with your CPA that keeps you just under the $25,000 or $32,000 threshold in years where it matters most, rather than taking one large lump sum that spikes you straight through 85%. Strategy 5 is delaying your Social Security claim itself. Every year you delay past your full retirement age up to age 70, adds roughly 8% to your eventual benefit, and in the delay years, you often have lower provisional income, which lets you execute Roth conversions and QCDs more aggressively while your Social Security income is not yet in the picture at all. Save this video right now, bookmark it, put it in a folder, call it your retirement survival file, whatever you want to name it. Because when that IRS notice shows up in your mailbox, when your CPA calls with a number you do not understand, when Medicare sends you an IRMAA letter you did not see coming, you are going to need to come back to this exact video and find the exact strategy that applies to your exact situation. Here is your window. Right now, in 2026, these thresholds remain frozen. Tax rates are set under current law, and the strategies I just walked you through are fully available to you under existing IRS rules. But every year you wait, more of your Social Security gets pulled into that 85% tier because your income rises and the threshold never does. The trajectory only moves in one direction: more retirees taxed, more automated enforcement, more people finding out the hard way, standing in their kitchen with an envelope in their hand. Like this video right now. Subscribe and hit that bell so you never miss the next trap I expose. Comment below with your own numbers so I can tell you exactly where you stand. Send this to one person today who needs to hear it. Save it to your library so it's there when you need it most. I am the retirement insurgent, and I am not here to make you feel better. I am here to make sure they never take another dollar from you without a fight.